Being around age 55 with less than 2 million in retirement savings is an interesting spot to be in. In this video, I'm going to show you how I help clients in this exact position retire earlier than expected, maximize drawdown and social security strategy, and minimize tax paid with no taxes at all paid in your initial retirement years. My name's George, I'm a financial planner and CPA who helps retirees get the most out of their retirement. So let's run through our example. We have a couple with 1.5 million in investments spread across IRAs, Roth IRAs, taxable investment accounts, HSAs, and cash. They also have social security of 2.5k a month each at their full retirement age of 67 and are looking to retire this year at age 55. They also have an income goal throughout retirement of 6k per month. Now, in situations like these, I like to split our planning into 3 distinct periods, all of which have distinct considerations we have to plan around. And the first is the situation we're going to focus on in this video, which is our pre-Medicare, pre-Social Security years of retirement starting at age 55. And here's what we need to consider during this period. Number 1 is healthcare costs. 2, distributions and penalties from our retirement accounts. And 3, tax efficiency and cash flow, specifically for this period where we have no Social Security. So let's start with healthcare costs. And in this case, we need to look at how ACA subsidies can play a part in our plan to offset insurance premiums. These subsidies are effectively in place to reduce the cost of health insurance for those under certain income thresholds. Generally, you have to fall between 100 to 400% of the federal poverty line to qualify. The amount of subsidy and resulting monthly premium you'll have to pay will depend on the specific plan you're in. In this case, the income threshold for our couple is $46,500 of taxable income, which is around 300% of the poverty line, which would in turn lead to a reduced $400 per month health insurance premium. In simpler terms, when we plan our withdrawals, we want to aim to be under this threshold to secure the lower premium rate. So to start, let's talk about our distribution and penalty section of our plan. First thing to highlight is our 401k balance. As I'm sure many of you know, if we withdraw from this account before the age of 59 and a half, we incur a 10% penalty. There is, however, something known as the Rule of 55. The Rule of 55 states that if you have an existing 401k with an employer and you left that employment from age 55 or later and still maintain that 401k account through the employer, you can take withdrawals without the 10% penalty. Let's now highlight our taxable brokerage account, because the 401k and taxable brokerage account will be our key accounts during this initial retirement period. Now, our taxable brokerage account will be taxed differently to our 401k distributions. Our 401k will be taxed as ordinary income, and our taxable brokerage account will be taxed as long-term capital gains. Now, you can see here that long-term capital gains for married filing jointly are taxed at 0% for taxable income of 98.9k or less. And by the way, you can grab this PDF of useful tax rates and thresholds in the first link in the description below. So the immediate thought here may be great. We can just withdraw from this account completely tax-free, as our income for the year won't exceed this threshold. And while that may be true, it actually isn't the most tax-efficient long-term approach, which may sound off considering we're paying zero tax. So let me explain. When tax planning, we need to keep in mind not only the immediate annual tax impact, but also the long-term tax impact. And in this case, if we simply withdraw from our taxable brokerage account, we're leaving money on the table because we would effectively be wasting our standard deduction of 32.2k. Remember, our 401k is tax deferred, not tax free, so we will be paying income tax on withdrawals from this account. So to make use of our standard deduction, we would ensure we're drawing down 32.2k from this account, which would also be tax free, and the rest we draw down from this taxable brokerage account. This maximizes our long-term tax efficiency and also gives this extremely valuable source of long-term capital gains income in our brokerage account to continue to grow so we can withdraw from it over a longer time horizon. Now, to touch on our Roth accounts, we want to avoid touching these for as long as possible. These are, of course, completely tax-free upon withdrawal. So while we still can draw down from our other accounts which aren't inherently tax-free without paying tax, we want to do so and leave this Roth account to continue growing, to be drawn down from as late as possible when we may drift into income brackets or situations where we can't withdraw from these other accounts as tax efficiently. So here's what our income and tax implications look like. $32,200 from our 401k, which is offset by our standard deduction, and 39.8k from our taxable brokerage account at 0% long-term capital gains rate. Now, this forms the core of our plan for our initial years of retirement. And for many, this is a great place to start to get comfortable with the basics of our plan. As mentioned, I want this video to not be overwhelming and to help specifically with this initial period. But let's briefly touch on a few additional areas you can consider around this initial retirement period. First, let's go back to our taxable investment account. Now, we performed simplified calculations earlier, but the reality is that this account will have a certain value which is made up of two distinct parts. Capital gains, which of course is the amount of growth on our investments that has generated through this account, and our principal, which is the amount you initially actually invested. Upon withdrawal, only the capital gain amount is considered taxable, and the principal of course isn't. This means that every withdrawal you make, you won't necessarily be taxed on that entire amount you withdraw. For example, if you say withdrew 50k, you may be looking at a taxable gain of 35k and a non-taxable principal distribution of 15k. Something to keep in mind that links back to our scenario and maximizing tax-free distributions is that as long as we are within this 0% long-term capital gains bracket, it may be beneficial to withdraw additional funds from this brokerage account above what you actually need. Now, why is this? Well, we may not be in this lower tax bracket when we want to withdraw these funds going forward. So taking as much out as 0% is almost always going to be beneficial. You can simply withdraw these funds and reinvest them in the exact same way, which conceptually may seem pointless, but what you're actually doing is resetting the tax base at which the capital gain is calculated, because you are actually paying taxes on this withdrawal, the tax just happens to be 0%. So for example, if we withdrew an additional 20k, 15k of which is a capital gain, and then we immediately reinvest it, we're removing any risk that this 15k will be taxed at the 15 or 20% long-term capital gain rates in the future, and assuming we reinvest it, any future gain is calculated with 20k as our principal starting point instead of the initial 5k principal that we originally invested. Also, this kind of tax gain harvesting is different to tax loss harvesting in the sense that when we tax loss harvest to purposely recognize a loss to offset our taxes, we have to wait 30 days before we can reinvest those funds. With tax gain harvesting, that rule does not apply. And one last quick point to consider if you're in a similar situation to the one discussed is to take a look at your investment allocation across your accounts. In general, it's more tax efficient to have a higher concentration of our higher growth potential equity funds in our tax-free Roth account, our lower growth, more stable securities like bonds in our tax-deferred 401k accounts, and our non-income and non-dividend yielding securities inside our taxable brokerage account. The reason behind this being we want our Roth accounts to be exposed to as much growth as possible due to the eventual withdrawals being completely tax-free. Our 401k account, of course, is taxable upon withdrawal, hence the lower growth allocations, and our taxable brokerage account is not tax-deferred like the 401k account, meaning that income and dividend generating securities do generate taxable income within this account. Now, you can achieve the same overall exposure based on your risk tolerance across these accounts, but just having these allocations in mind can really help increase your tax-adjusted value of the accounts over the long run as you go through retirement. So to summarize, what we've achieved here is completely tax-free and penalty-free withdrawal strategy for our initial stretch of retirement, where we also qualify for the ACA subsidies and hit our monthly income goal. Your situation will of course be different, but I hope you can at least take elements of this scenario into account to help with your retirement planning needs. If you'd like to talk to me directly about any of your retirement planning questions, completely free of charge, please feel free to book a call using the second link in the description. Thank you all so much for watching, and I'll see you in the next one.